This video discusses the third of the 5 steps in accounting for revenue based on IFRS 15's 5-step model for accounting for revenue. So far, you would have identified that there is a contract with the customer. You would have then analyzed that contract for the separate performance obligations in that contract. Now you need to determine the transaction price. Revenue is then recognized at this transaction price as the performance obligations are satisfied, either at a point in time or over a period of time. The transaction price is the value of consideration that you are expected to be entitled to for the transfer of your goods and services to the customer, but it excludes amounts that you have collected on behalf of third parties, for example, sales tax or value-added tax. The transaction price need not necessarily be a fixed agreed upon amount up front. It may contain some variable components, such as discounts or rebates, but it may also contain amounts that are contingent on other events that need to happen or not happen in the future. Consider the following example involving some contingency. E Limited entered into agreement with F Limited, whereby in terms of this agreement they will sell them products at a normal selling price, and they will only grant discount to them, a volume discount of 3%, if the sales for the period are in excess of 1 million rand at the normal selling price. So for the first 6 months of the reporting period ended 30 June 2014, E Limited has sold goods to F Limited for 350,000. This is so far half of what they would need to qualify for the 3% volume discount. However, you also then know that during the previous 2 financial reporting periods that they have in fact met this target and exceeded it quite comfortably with selling prices in excess of 1.5 million rand. Therefore, it seems more likely than not that they will attain these targets again this year unless there's information to the contrary, so they seem to be qualifying for the volume discount. Your revenue recognition then will take that into account at 30 June, even though the target hasn't been met yet for this year. So you've taken your 350 less the 3% discount for your revenue recognition. Assuming that your sales threshold is met, your debtor will pay this amount and there's no adjustments. If the debtor, however, does not meet the sales threshold, that discount is effectively now reversed and recognized as revenue, and you catch it up now at the point when you realize that your estimations have changed. There may be instances where your transaction price may be a range of possibilities that will be determined on the occurrence or not in future of various events. If there are 2 possibilities that you think the revenue might be A or B, then decide for yourself which is the most likely amount. In an instance where you have a range of possibilities dependent on numerous outcomes and effects, then you may want to take a probability weighted amount. Consider the following example to illustrate these 2 options. There's a warehouse being constructed and the contract price that's been agreed is 1 million rand. A performance bonus will be payable of 500,000 rand should the construction be completed by the agreed date. This bonus decreases by 10% per week for every week that production extends beyond the agreed date. As the accountant, you would now sit and have a look at the probability of when you think this construction will be completed and what revenue you will be entitled to for it. Discussions with management may take place, and this might lead, for example, to a 60% probability that the contract will be completed on time, a 30% probability that it will be 1 week late, and a 10% probability that it will be 2 weeks late. You are in this case looking now at a range of outcomes which is more than 2. So you are probably going with the probability weighted method. The revenue that is fixed in this is the 1 million rand. The bonus part is variable. and there is a 60% chance that you'll finish on time and be entitled to the R500,000. Then there's a 30% chance you'll be finished a week late. If you are finished a week late, the bonus, remember, decreases by 10%. There's then a 10% chance that you'll be 2 weeks late, so the bonus decreases by 20%, being 10% per week. Using that weighted average, you can now determine that the most likely amount in estimation terms that you will be entitled to will be R1,475,000. If you had elected to go with the most likely outcome, despite it being more than 2, the 60% chance is the most likely outcome, and you would have measured it at 1.5 million. When determining your transaction price, you also need to sit back and consider whether that transaction price contains a financing element. Has there been a period of time granted to the customer to settle his obligations? Whether you say that explicitly or implicitly in the contract, you will need to evaluate that contract in terms of substance over form and see if there's not a period of financing involved there. That the goods, for example, were delivered today and the customer only needs to pay you in 2 years' time. There will then be a financing element. You may say in the contract that this is a contract for the sale of goods for R2 million, not mention a word of financing, and that the R2 million is due in 2 years' time. Substance over form tells us that that money due in 2 years' time must contain, in terms of economic principles, an interest amount over the 2-year period. IFRS 15, though, does say that if you evaluate the contract and you determine that there's a financing period involved, if that period is less than a year, you may disregard, for practical purposes, going back to the principle and the framework of cost over versus benefit, you may disregard that financing component for that short, immaterial period of time. Then you must also remember, when you recognize that there is a financing component, you need to take that out, as that financing component is not recognized in the revenue line item. Let's consider an example now of the financing component. On 1 July 20X14, A Limited entered into a contract with E Limited. In terms of this contract, A Limited will deliver a product to E Limited on 1 July 20X14. The contract price is 1.4 million and is payable by E Limited to A Limited 4 years later in 20X18. At the moment, that appears to be the transaction price. We continue reading, and it then says that the regular cash selling price for this product is in fact R900,000. Given that there's now a significant period of time, the 4 years, and that the selling price today differs from what will be settled in future, you can already see there's a financing element involved here. The question then continues to give the costs involved for the cost of sales. Looking at your general journal entries then for this transaction to account for it. On the date of sale, you recognize your revenue then at the current selling price, which is the 900,000. You recognize in terms of IS2 the cost of sales of 590. The interest component then, being the difference between the 1.4 million and the 900,000, then needs to be recognized using the effective interest rate method over those 4 years. So it will be your present value, the 900,000, with the effective interest rate, which has been calculated above, using the 1.4 as your future value, the 900,000 as your present value, gives you the 12%. So it's the present value times that 12% for the period of time that has elapsed to your reporting date.